However, as can be seen in the long-term chart, the coincident economic indicator tends to lag the leading economic indicator. Therefore, I believe the coincident economic indicator will follow the already declining leading economic indicator and fall again this time. Nice to meet you, dear viewers of the Eldorado YouTube channel. This is stock investment expert Byung-Hyun. As the stock market moves sideways without showing a clear rise or fall, our investors will be curious about the prospects. As an investor, I am also always curious about these prospects, and I'm making stock investment by referring to the prospects presented by various organizations. One of the organizations I refer to has previously forecasted a decline in the stock market. This time, the organizations gave a forecast related to the stock market, and I will check whether it is forecasting a continued decline in the stock market or rise in the stock market due to a rebound in the economy. Weekly working hour. Weekly working hour represents the number of hours worked per week by employees employed by a company. An increase in working hour indicates an economic expansion, while a decrease in working hours indicates a contraction. This principle stems from the fact that during an economic expansion, as order increase, employees' working hour increase to meet production volume. Conversely, during a contraction, as order decrease, employees' working hours decrease. As a result of reduced work hours, currently, weekly working hours are steadily decreasing, even lower than during the COVID-19 pandemic. Judging by the weekly working hour, the economic slowdown is clearly underway. Yet for some reason, the stock market has been rising for a long time. However, over the long term, statistically, the stock market declined when weekly working hours decreased and rose when weekly working hours is increased. The chart you are looking at now shows the relationship between weekly working hours and the S&P 500 stock market. The blue chart represents the S&P 500, and the orange represents weekly working hours. You can see that when weekly working hours increase, the stock market tends to rise, and when weekly working hours decrease, the stock market also tends to fall. In 2008, the stock market declined as weekly working hours decreased. Similarly, in 2020, the stock market declined as weekly working hours decreased. Currently, weekly working hours are decreasing, and the stock market is expected to decline accordingly. Comparison of leading economic indicator and coincident economic indicator. Leading economic indicators are economic indicators published by the Commerce Board and are used to forecast economic trends for the next 6 to 12 months. It is a comprehensive index comprised of 10 indicators, including manufacturing new orders and housing permit. A decline in the leading indicator is interpreted as a sign of an economic slowdown or recession. Coincident indicators, also published by the Commerce Board, accurately reflect the current economic situation and are used along with leading indicators to assess and forecast economic trends. It is a comprehensive index comprised of indicators such as the industrial production index, retail sales, and employment. An increase in the coincident indicator indicates a positive economic situation. The chart you are viewing compares leading and coincident economic indicator. The blue color represents leading economic indicator, while the black color represents coincident economic indicators. You can see that the leading economic indicator read, while the coincident economic indicators lag. In 2001, the leading economic indicator fell first, followed shortly by a decline in the coincident economic indicator, which led to a stock market decline. In 2008, the leading economic indicator fell first, followed shortly by a decline in the coincident economic indicator, which led to a stock market decline. In 2021, leading economic indicator fell first, followed shortly by coincident economic indicator, leading to a decline in the stock market. Despite the current decline in leading economic indicators, coincident economic indicators have not yet declined. Many investors are concerned about an economic slowdown and recession because the leading economic indicators have been in a downward trend for such a long time and have declined so deeply. Looking back at past stock market history, a recession has almost always followed the downward trend in leading economic indicators. However, even after a significant period of time has passed since the current downward trend in leading economic indicators, a recession has not yet begun. This is because a coincident economic indicator has not yet entered a downward trend. The coincident economic indicator includes the industrial production index, and since the industrial production index is currently showing an upward trend, we believe a downward trend has not yet occurred. However, as can be seen in the long-term chart, the coincident economic indicator tends to lag the leading economic indicator. Therefore, I believe the coincident economic indicator will follow the already declining leading economic indicator and fall again this time. When that happens, the stock market will decline, bond yield will fall, and bond price will rise. While the coincident economic indicator is currently rising, it's unclear how far or how long this will continue, and I will need to continue monitoring. Furthermore, if the stock market corrects and declines, I believe it would be a good idea to increase your exposure to stock with strong fundamental and future prospects to increase your expected returns. I will discuss stock at the end of the month. Today, I share my personal views on the stock and bond market based on weekly working hours, leading economic indicators, and coincident economic indicators. As these are my personal opinions, there is a high chance I'm wrong. Please leave your comments and I will humbly accept and review them.